not your dependent, you still can do it. If it's not your client's dependent, they can still file as head of household, but they must enter the child's name in box 4. I had a case example many years ago. I had a client come to me, and we had looked at their tax return, and the CPA never even questioned the fact that they could possibly file as a head of household. When we redid their return and filed it as a head of household, because they did have a qualifying child, they did qualify for this parameter, there was a significant savings to them. So do not forget to ask your client this question if there's the possibility of married filing separately, or possibly filing as head of household because there's a qualifying child at play. And again, these brackets are a little different. So now you see where it says not over $13,600, it's a 10% tax rate. If it's over $13,600, it's a 12% tax rate. If it's over $51,800, it's a 22% tax rate. If it's over $82,500, it's a 24% tax rate. Over $157,500, a 32% tax rate. Over $200,000, but not over $500,000. We're back to the 5, right? 35% tax rate. We don't have the penalty that we see in married filing separately if we can file as head of household. And then over $500,000, it's a 37% tax rate, as we see previously. And just a comment here too, on the boxes that you check. On page 1 of the 1040, you check box 4 if you're married filing as head of household. You check box 3 if you are married filing separately. You check box 2 if you are married filing jointly, and box 1 if you are an individual. And there's also a box 5 on page 1 of the 1040 for a qualifying widower with a dependent child. So if someone was widowed during the year, they can check box 5 as long as they have a dependent child to check that as well. Okay, we're on slide 11, and what we're looking at here is the existing first page of the 1040, and we're looking at the income section. And I said these are the lines that it's going to cover, 7 to 22. And you can see where now the income goes into these lines, and what we may say may change. And that's what I wanted to highlight here, is what's possible of changing here. So as we see in line 11, as you'll hear, alimony received is going away as a taxable item for the time being. Keep in mind that cut expires as of the publication of this program. So alimony received may go away. That line should not be there on our new forms when we see them in 2019. Will it be replaced? We don't know. You've got to pay particular attention to these areas now for next year. I just wanted to highlight your attention to line 8B, as in Bravo. Tax exempt interest. They still want you to report tax exempt interest, even though it's not taxable. And look at what it says. Do not include that on line A. It does not get added into the total amount of taxable income, but the IRS does want to see it reported. Examples may be municipal bonds. There may be municipal bonds that your client bought that are tax exempt, and that's where that interest would go. Schedule C, which shows up on here as well, on line 12, that you see business income or loss. Attach a Schedule C. There's been a lot of changes to the way we run our companies and the way your clients run their businesses and what they can deduct. If your client is...
Okay, so you guys, sorry I look a mess, but so what he's talking about, basically, you're going to have clients who have not actually registered their business directly with the state, the county, and the city. And because they have not done so, they have not fully incorporated their business. So their income goes onto a Schedule C. So it's business profits and losses. However, when you put it on the Schedule C, you're losing a lot of deductions, a lot of exemptions that you would be able to qualify for had you put those same that same income in a 1065 partnership, 1120, far as a S corporation, also in an LLC, depending on how you structurize that LLC. If it's a series, you'll be able to get more tax write-offs. But if you put the income directly onto the Schedule C, you are subject to Medicare taxes of and Medicare and Social Security taxes. So when you put the income into the Schedule C, you'll see a tax, and they'll say a self-employment tax. And that's them allocating the taxes for Social Security and for Medicare. So be careful of that, because you'll have clients who you want to go, once you file their taxes and you see that it is on the Schedule C, you want it to start to understand what type of business this is, so that you can direct them into the right structure, such as if it will be a S corp or a C corp, or however is best effective to put them in a different status that they're in. So I'm gonna let him just continue to talk, just because I need the video to get through.
Is not incorporated. And I really wanted to go over this year, because I get a lot of questions throughout the year, as I know some of this stuff can get confusing if you don't practice business law and you don't practice the incorporation of a company during the year. If your client runs a business and it's not incorporated, you're probably filing the actions of that business on a Schedule C, which gets attached to the 1040. Or it could be incorporated as a limited liability company and what we call a disregarded entity. In other words, they formed an LLC, your client formed an LLC, but then your client said, I don't want to file a company tax return. I want to file the profits and losses of the business on a Schedule C. That's what's called a disregarded entity, and your clients can do that. They're going to pay the tax on that profit right here on their personal tax return. So you've got to ask them. If they're an LLC, you've got to ask them, well, are you filing a Schedule C, or did you elect to be a partnership, and are we going to file a 1065 tax return? Did you elect to be an S corp, and we're going to file an 1120S? Or did you elect to be a C corp, and we're just going to file an 1120? If they didn't do those, they could possibly be disregarded and file a Schedule C. Also, another note on LLCs. In the event that they filed an LLC, they should have filed Form 8832. That's the entity election form, entity classification election, telling the IRS what they want to be. If they're an individual LLC, they will default to a disregarded entity, and they'll file a Schedule C, and you'll file a Schedule C for them for this tax year. If it's two people and they created an LLC and they did not make an election, then you'll file a 1065 partnership for them, and you will not attach the Schedule C here. I draw your attention to line 15A, and I specifically wanted to show you the IRA distributions here. That early withdrawal of IRA distributions is potentially taxable to the client unless it's exempt. I had a case happen the other day. I had a client call me and say, Roman, I didn't realize what I did, but a couple years ago I was in an accident and I took out my 401k and I didn't report it to the IRS. And now when I went to go file my tax return and get my refund for the year, they kept my refund. And I said to him, well, that's an early, he's a younger person, he's in his 30s. So I said, well, that's an early withdrawal of your IRA. And it's taxable to you at ordinary income tax rates, depending upon what type of IRA it is. We'll discuss that later. But it's potentially taxable at ordinary income tax rates. And there's a 10% penalty on top of that for early withdrawal, plus interest from the date it was due. But then he says to me, he says that I was in a bad accident. So we looked up the rules, and the rules say it's exempt. IRA distributions may be exempt if you're permanently disabled. So then he has an interesting situation, which is of course why he would call a taxi attorney. At the time of the accident, he was adjudicated as permanently disabled. He recovered very well after the fact, but his medical records all showed that he was permanently disabled. So he withdrew his funds for that, and now he's no longer disabled. It wasn't as permanent as they thought, but when he took out the funds, it was. It brings up the question of, do we report it there or not? And then we'll start looking out for case law. I just bring that up to show you that's where that goes. And a lot of you have clients that take out those distributions early. That's where it will show up. Draw your attention as well to the possibility that your clients might file a Schedule E, and that's where you would show it on line 17. A lot of your clients have rental real estate, or they may have an S corporation, a partnership filing a 1065. This is the flow through. When we say it's a flow through entity, this is what we mean. The profit of that business flows through to line 17 on the tax return. Now, starting in 2018, 20% of those profits are not taxable to you as an individual. How this is going to show up on the tax return, we don't know, and we won't know until we start filing the tax returns and we see the new forms. But if you have a flow through, if it's a partnership, if it's an S corp, possibly a trust, be careful there, but possibly a trust. The new tax law says 20% of that is not taxable. Whether that'll show up on the form for the company or whether there will be a secondary line here that shows up, we don't know. Also, think about line 12. Attaching a Schedule C for business income and loss. That's a flow through. It should get the same 20% deduction treatment. So we don't know where that's going to come in. And again, please do not confuse this with Schedule C's do not confuse this with C corporations that are filing 1120s that do not flow through. And those are taxed at 21 years. We'll talk about that later again. Okay, let's move on to slide 12. And now we're going to switch gears. We've been talking about ordinary income taxes, and you've seen the rate changes, and you've seen the bracket changes, and you've seen where on our tax return we are reporting it. So let's talk about capital gains tax rates. Net capital gain. You may be eligible for the
Okay, you guys, so that is the conclusion of video number 2. He's going to go directly into capital gains. And capital gains, we'll break capital gains down in the next video once he starts to go through with that. So if you have any questions, make sure you reach out to me, Facebook me, or inbox me, email me. You have my contact information, so reach out if you guys have any questions. All right, we're done for this video.